Picture a warm bakery cafe on a Tuesday morning. The smell of fresh sourdough. A line out the door. A phone buzzing with a personalized loyalty offer. That's Panera Bread at its peak. Over 2,000 bakery cafes across the US and Canada, billions of dollars in annual system-wide sales, and a $7.5 billion acquisition price tag that made it one of the biggest restaurant buyouts in history. But just a few years later, lawsuits over a deadly drink. Price backlash from loyal customers. Corporate layoffs. A brand once considered untouchable, suddenly fighting to prove it still mattered. How does a company that built one of the most admired growth models in restaurant history end up here? Big numbers, a shrinking timeline, and a total reversal of fortune. That's what we're unpacking today. In this video, I'm going to walk you through exactly how Panera Bread rose from a struggling regional bakery into a fast casual empire, and exactly where the cracks started to form. We'll cover the founder who bet his career on bread, the acquisition that quietly built the foundation for everything, the tech-first strategy that put Panera years ahead of its competitors, and the slow, compounding failure that turned a beloved brand into a cautionary tale. But stick around, because at the end, I'm going to show you one specific detail, a single ingredient in one drink, that tells you almost everything about how a company can win for 30 years and still lose control of its own story. It's more symbolic than you'd expect. To understand Panera, you actually have to start with a company that isn't called Panera at all. Back in 1981, an entrepreneur named Ron Shaich partnered with Louis Kane to found Au Bon Pain Company, Incorporated. It officially launched in March of that year with just 3 bakery cafes and a single cookie store. Tiny. Almost forgettable. But Shaich and Kane weren't chasing the same playbook as everyone else in American fast food. While most chains in the early 80s were doubling down on burgers, fries, and drive-through speed, Au Bon Pain went the opposite direction entirely. They built the business around French-style artisan bread, a category almost nobody was taking seriously in mainstream American food service. That's the first clue to why this story eventually works. They did the opposite of everyone else. And the timing was right. American consumers were slowly shifting toward the idea that food could be an experience, not just fuel. Au Bon Pain expanded rapidly through the 1980s across the East Coast, and even pushed into international markets before Panera existed as a name at all. By the early 1990s, it had become one of the largest bakery cafe operators in the country. Meanwhile, in a completely unrelated part of the country, a much smaller story was unfolding. In 1987, Ken and Linda Rosenthal founded St. Louis Bread Company in Kirkwood, Missouri. Ken had been inspired by the tradition of San Francisco sourdough, and he built his new bakery around the same principle Au Bon Pain had bet on. Fresh, handcrafted bread, baked daily, not mass-produced. St. Louis Bread Company wasn't trying to be fast food. Customers could literally watch the bread being baked throughout the day. It became a neighborhood institution: soups, salads, sandwiches, and that now famous sourdough. And by 1993, it had grown to 20 bakery cafes across the St. Louis area. That's when these two separate stories collided. On December 22, 1993, Au Bon Pain acquired St. Louis Bread Company. On paper, it looked like a modest regional bolt-on acquisition. In hindsight, it was the single most important decision in the company's history. People were hungry for something Au Bon Pain wasn't fully offering yet: a warmer, more personal, more handcrafted version of casual dining. St. Louis Bread Company had already found it. Au Bon Pain just needed to recognize it. Here's where the growth engine actually gets built. After the acquisition, Ron Shaich made an unusual choice. Instead of rushing to expand the newly acquired chain nationally, management spent years quietly improving the concept. Between 1993 and 1997, average sales per St. Louis Bread Company cafe increased by roughly 75%. That number alone told Shaich everything he needed to know. This small St. Louis bakery chain had more long-term potential than the entire Au Bon Pain brand he'd spent over a decade building. That's an enormous thing for a founder to accept. But Sheich believed customers wanted higher quality meals than traditional fast food could deliver, and he was willing to bet the company's future on it. In 1997, the brand name, Panera, was adopted, derived from a word related to the Latin panarium, meaning breadbasket, as the company prepared to expand nationally outside Missouri. The menu combined artisan bread, soups, salads, sandwiches, pastries, and coffee into a single cafe experience designed to feel like a warm neighborhood spot rather than a fast food restaurant. This is where the unfair advantage really kicks in. Instead of building every new location itself, Panera adopted a franchise model to accelerate growth. But it wasn't a loose franchise system. Partners were required to commit to opening multiple cafes at once, which let Panera expand into new markets fast without draining its own capital. At the same time, the company quietly built one of its most durable competitive advantages, a network of centralized fresh dough production facilities that supplied bakery cafes with consistent product every single day. This meant a Panera in Ohio tasted the same as a Panera in Texas, a level of consistency that's brutally hard to replicate at scale, especially for a brand built on handcrafted positioning. Then came the final structural move. In 1998, the company agreed to sell off the original Au Bon Pain division entirely, completing the sale on May 16, 1999. The company officially renamed itself from Au Bon Pain Company, Inc. to Panera Bread Company. Management used the proceeds to eliminate debt and pour capital directly into Panera's expansion. This allowed them to grow faster than anyone thought possible. By the end of 2000, Panera operated 90 company-owned bakery cafes and 172 franchise locations, and the strategy was already built around 4 clear customer occasions: breakfast, lunch, afternoon visits, and take-home bread purchases. Unlike competitors racing towards speed, Panera invested in cafe atmosphere, encouraging people to actually stay. By the early 2000s, Panera wasn't just growing. It was becoming one of the fastest-growing restaurant concepts in the entire United States. By the mid-2000s, it had firmly established itself as a pioneer of an entirely new category, fast casual, sitting comfortably between traditional fast food and full-service dining. New bakery cafes kept opening at a rapid pace, blending company-owned and franchised locations, and the brand kept investing in artisan bread, fresh ingredients, and ambience instead of competing on price. Breakfast became one of the fastest-growing parts of the business, powered by bagels, pastries, coffee, and breakfast sandwiches. Lunch remained the company's biggest revenue driver, and one menu innovation in particular became a cultural signature: the You Pick Two combination meal, letting customers pair half portions of soups, salads, or sandwiches. It increased average spend while giving customers a sense of control and customization, a small design choice that quietly drove years of revenue. Panera posted consistently positive same-store sales through much of the 2000s, outperforming a huge chunk of the restaurant industry. And then it did something most restaurant chains at the time weren't even thinking about. It bet early on technology. In 2011, Panera launched My Panera, a loyalty program built around personalized offers instead of a traditional point system. It quickly became one of the largest restaurant loyalty programs in the country, pulling in millions of members and giving Panera a data advantage almost nobody else in the category had. That data fed directly into Panera 2.0, a digital transformation initiative worth hundreds of millions of dollars, introducing self-order kiosks, mobile ordering, rapid pickup, and digital menu boards years ahead of most competitors. It cut wait times during the brutal lunch rush and made Panera one of the first major bakery cafe chains to build out its own delivery network. Then, in 2014, Sheich announced the Clean Food Initiative, a public pledge to remove artificial colors, flavors, sweeteners, and preservatives from Panera's menu. By January 2017, the company announced it had completed that promise, removing hundreds of artificial ingredients. It reinforced Panera's identity as the healthier, more trustworthy alternative to fast food. Investors noticed. Panera's market value climbed dramatically through the 2010s. By 2017, the chain had grown to more than 2,000 bakery cafes across the US and Canada, generating billions in annual system-wide sales. And then, on April 5, 2017, JB Holding Company announced it would acquire Panera Bread for approximately $7.5 billion, including assumed debt, at $315 per share in cash, a massive premium over its stock price. When the deal closed in July 2017, Panera went private after nearly 3 decades as a public company. This was the peak, the absolute top of the mountain. Nothing here hints at what's coming. Here's the thing about going private under a company like JB Holding. It solves some problems and quietly creates others. Once Panera became privately held, it no longer had to publish quarterly financial reports. That sounds like freedom, and in some ways it was allowing longer-term thinking without the pressure of quarterly earnings calls. But it also meant less public accountability and less external scrutiny at exactly the moment JB was reshaping Panera into one piece of a much larger empire. JAB's strategy was to combine Panera with other major coffee and bakery brands, Krispy Kreme, Pret A Manger, Caribou Coffee, and Peet's Coffee, into one sprawling global food service portfolio. On paper, that's synergy. In practice, it meant Panera was no longer the singular focus of a founder's life's work. It was now one asset among several, competing internally for capital, attention, and strategic priority. This didn't look fatal at all in 2017 or 2018. Panera kept investing in digital ordering, curbside pickup, and delivery, building on the Panera 2.0 foundation. But the seed had been planted. A brand built on founder-level obsession with quality and consistency was now part of a portfolio, managed at a distance, inside a private structure with far less public visibility into how it was actually performing. This is where the story stops being about one bad decision and starts being about a slow accumulation of pressure. A market shift nobody could fully control. By the start of 2020, digital sales had become a major part of Panera's business, which, at first, seemed like great timing. When COVID-19 struck, Panera was genuinely better positioned than many competitors. The company pivoted hard toward delivery, drive-through, rapid pickup, and off-premise dining as dining rooms across the country shut down. It even launched Panera Grocery, temporarily selling milk, bread, eggs, and pantry staples during supply shortages, and rolled out family meal bundles for households stuck at home. That's a genuinely impressive adaptation. But surviving a crisis and thriving after one are two different things. Rising costs that never really went away. The pandemic drove labor costs, food costs, and supply chain pressure sharply upward across the industry, and Panera wasn't immune. As inflation accelerated after 2021, Panera raised menu prices multiple times to offset those costs. A value perception problem. Every price increase chipped away a little more at customer goodwill. Some customers began openly criticizing the brand for feeling more expensive and offering less perceived value than it used to. For a chain that built its entire identity on worth the premium, that's a dangerous shift in sentiment. A loyalty strategy that started walking a fine line. To keep driving repeat visits, Panera expanded its Unlimited Sip Club, a subscription program offering unlimited self-serve beverages for a monthly fee. It became one of the company's most important loyalty tools, boosting visit frequency and digital engagement. One of the drinks folded into that program was Charged Lemonade, a heavily caffeinated beverage marketed alongside the chain's usual lineup of coffee, tea, and soft drinks. Reputation damage that hit at the worst possible angle. Beginning in late 2023, multiple lawsuits alleged that Charged Lemonade had contributed to serious health incidents and deaths among people with underlying health conditions. Panera disputed the claims and defended the product, but the lawsuits triggered widespread media coverage and raised uncomfortable questions about how the drink had been marketed and labeled in the first place. Each of these pressures on its own might have been manageable. Stacked together, rising prices, eroding value perception, a loyalty program under public scrutiny, and mounting legal exposure, they created a compounding problem that no single fix could solve. The lawsuits over charged lemonade became the moment the story tipped from manageable challenges into something the public couldn't ignore. This wasn't a stock market crash or a sudden executive scandal. It was slower and more corrosive. A wellness-positioned brand, one that had spent a decade building trust through its clean food initiative, was now facing headlines about a drink linked to serious harm. In 2024, Panera confirmed it would discontinue charged lemonade as part of a broader menu transformation. Notably, the company never publicly stated the lawsuits were the reason, but the timing spoke for itself. That's the moment where the audience, and Panera's own customers, subconsciously started to feel it. Something had shifted. The brand that once symbolized healthier than fast food was now defending itself in court over one of its own signature drinks. To be clear, Panera didn't go bankrupt. It didn't shut its doors. This isn't that kind of collapse. But the unraveling shows up in quieter, more telling ways. In April 2024, Panera rolled out one of its largest menu overhauls in years, adding and updating dozens of items to try to improve value and simplify operations. The company said the goal was to strengthen customer satisfaction and reignite sales growth, language that, read carefully, is an admission that growth had stalled and satisfaction had slipped. Behind the scenes, reports indicated that Panera restructured parts of its support organization and reduced some corporate roles as it pushed for operational efficiency. The company also leaned harder into AI-assisted ordering, digital personalization, and loyalty data, betting that technology could once again be the differentiator it had been a decade earlier with Panera 2.0. But the competitive landscape had shifted dramatically. Panera was no longer competing against traditional fast food. It was now fighting Chipotle, Cava, Sweetgreen, and established coffee giants like Starbucks, all chasing the exact same fast casual, quality-conscious customer. And industry analysts noted something structural. Consumers had become more price-sensitive across the board, making it far harder for any premium restaurant chain to sustain the explosive growth rates it once enjoyed throughout the 2010s. By the mid-2020s, Panera's challenge wasn't expansion anymore. The era of racing to open thousands of new locations was over. The real fight was about maintaining traffic, protecting value perception, and defending brand differentiation in an increasingly crowded market. Remember that detail I promised you at the start? Here it is. Charged lemonade. Think about what that single product represents. It wasn't a failed store location. It wasn't a bad quarter. It was one drink added to a loyalty subscription designed to keep people coming back more often. A symbol of everything that built Panera's success: fresh-feeling innovation, aggressive marketing, and a loyalty-driven growth engine. And it became the exact same symbol of everything that put that success at risk. A product pushed to market without enough scrutiny on how it interacted with real customers' health, marketed inside a brand that had spent a decade telling people it stood for clean, transparent food. The empty space where charged lemonade used to be on the menu isn't just a discontinued item. It's a small, quiet monument to how a company can spend 30 years building trust and lose a meaningful piece of it over a single beverage. So what's the actual lesson here? Panera's story proves that a company can build a multi-billion-dollar brand through genuine innovation and disciplined execution. The fresh dough system, the loyalty data, the digital-first infrastructure, the founder's willingness to bet everything on a smaller, better idea instead of the safer, bigger one. All of that was real. All of that worked. But building the brand and sustaining it are two entirely different disciplines. Sustaining it requires continually adapting to changing consumer expectations, rising costs, new competitors, and operational realities that never sit still. The same instinct that made Ron Shaich walk away from Aubon Pain to bet on a tiny St. Louis bakery chain is the instinct every growing company eventually needs again: the willingness to notice when something that used to work has quietly stopped working before the customers notice it first. Panera didn't fail because it stopped innovating. It struggled because some of that innovation outran the scrutiny it needed. So here's what I want to know from you. Was this collapse inevitable the moment Panera went private in 2017? Or was it a series of avoidable missteps that any company could have made? And more importantly, can a brand like Panera fully win back that trust? Or has the fast casual category simply moved past it? Drop your thoughts in the comments. I read every single one.